Earlier this week, I made a video on real estate and the gold ratio and about the evil changes that were made back in 1971 where the dollar was depegged from gold. And now inflation became a problem as we know it today. And of course, real estate can hedge you from that. So before we call it evil, let's understand the problem maybe and why they made this change from a gradual growing ratio of gold to real estate to today, where real estate is actually one of the cheapest it's been since 1890, according to the gold ratio, because of inflation. All right, so to understand monetary policy back then, we have to understand supply and we have to understand demand as it relates to the currency, the dollar at the time. It was pegged to gold, which means that the amount of gold that we can mine would increase that supply, but a very slow rate compared to the economic output at the time. So that leaves us with a problem. As the United States economy booms and as the population increases, the demand for that dollar increases a lot. And what does that do to price or the value of that money? It goes up. The problem then becomes if you own an asset, then the value of your asset goes down in terms of dollars. Why is that? Because people are valuing more the money than they're valuing your asset or the house that you own. That created a lot of problems for virtually every business in America, but it became extremely more complex when we started looking internationally. Because internationally, we have other countries like Germany on a fiat policy, paying their people in a fiat currency that they're inflating, and then they're shipping Volkswagens over here where we're buying them in dollars, and they're basically getting a certificate for gold that they can extract from our country. We also had a lot of investments for pensions and so on and so forth in assets, and if assets are losing value because of our economic output and the demand for the dollar, that creates a lot of problems for people's retirement and financial stability. So although this new monetary policy is not really perfect and it does create problems like inflation and understanding how to hedge yourself against inflation, the important thing is that you learn what can you invest in to protect yourself from the new monetary policy.